What's up, everybody? Welcome back. So today I have a lot to talk about in this video about the stock market, and I have a few ideas that I think will be really interesting. It's essentially what Michael Burry is doing. He's buying a ton of farmland, and I want to talk about if that's a good investment, why I think it's potentially a good hedge against inflation, and just more details about what's going on right now in the stock market. Okay, so let's just get right into it. Okay, so I wrote an article recently talking about how Michael Burry bought a ton of farmland. And he hasn't just been buying it recently, he's been buying it 12, possibly even longer years ago. And ever since then, he's made a ton of money. So in this video, I want to talk more about why he's doing that, the reasoning behind buying farmland, including Bill Gates. He's also buying farmland, and why I think is potentially an investment that you want to take a look at. Okay, but before that, I want to talk about this article that I saw recently. Charlie Munger. Okay, Charlie Munger, if you guys don't know, is the legendary Warren Buffett's sidearm, his partner, the guy who's made billions of dollars for Berkshire Hathaway. He predicted that there's considerable trouble for markets this year. Okay, so earlier this year, Charlie Munger predicted that the markets would face considerable trouble. And is he right? As we can see, the market has been down quite a bit, right? And so if we take a look more into the article, this is what he said. He said, what we're getting now is wretched excess and danger for the country. Everybody loves it. And it's like a bunch of people getting drunk at a party. They're having so much fun getting drunk that they don't think about the consequences. Eventually, there will be considerable trouble because of the wretched excess. And that's the way it's usually worked in the past. Okay, so let's just kind of break that apart and let's see if there's truth in what he said. And just to take a quick look at one of the things that measures the market and how expensive it is compared to historical averages. And one of the indicators that's most clear is the price to earnings ratio. Okay, so P ratio is a classic measure of a security's value. Okay, so and it basically indicates how expensive the stock market is today, right? And historically, the average has been around 19.6. So anytime you have something an average that's above that, the market is more expensive. Okay, if it's below that, then it would be considered undervalued or cheaper. Okay, so right now, guys, the S&P 500, so the 500 top companies in the U.S. economy, their 10-year PE ratio is sitting at 29.7. So are we trading at prices that are more expensive? And the answer is yes, right? If you take a look at the chart, right now you can see that there was a bubble in 2000, and that's where we had the crash. We bottomed later on in 2008. Same thing. There was another crash, and right now, guys, we are sitting at historically pretty high prices compared to what it should be, right? So does that mean there's going to be a crash? I don't know, right? No one can really predict the stock market. And one of the other things that Charlie Munger said is there's been so many short squeezes, retail investors getting slammed into these companies like GameStop, AMC, Bed Bath and Beyond, where institutions tack on to these Wall Street Reddit, what is it? Wall Street bets on Reddit people that are just flooding the market with crazy call options, guys. Like call options that doesn't even make sense, right? Bed Bath and Beyond should not have been such an expensive stock. AMC should not have been such an expensive stock. GME should not have been such an expensive stock, right? But as we can see in the last year, these stocks have surged in value because investors are crazy about getting into the phase of whenever stocks are just shooting up. And unfortunately, while there may be some people that made a lot of money, like this college student named Jake Freeman, who made like $112 million on Bed Bath and Beyond, the reality is most people, most investors, retail investors, lost a lot of money. And you see just screenshots of bank accounts of brokerages just getting shattered because of this short squeeze, right? And that's one of the realities that we've seen more so in the last 1 or 2 years, is that a lot of these retailers who are getting into the market are just getting slammed They're losing their entire portfolio because they think they're going to time the market correctly and get in on the next Bed Bath & Beyond stock at the right time. So that's the sad reality of where our market is. One of the things that Charlie Munger also went out to say is forward returns are more likely to be lackluster. That means that the earnings for a lot of companies, especially in tech growth like Google, Apple, Netflix, all these companies that used to experience high growth and were just riding the train of profits, are going to experience this season where there's a lot more slowed down growth, right? And we see that in so many different cases, like Facebook, Apple, Google. A lot of these companies have essentially almost stopped hiring altogether, right? And not only that, companies like Facebook, right? Mark Zuckerberg has even said that the people who are essentially lazy, right, are going to get cut, right? And he's using algorithms to cut out his employees. So a lot of these companies who have a ton of cash, it's not like they're struggling. It's not like they can't afford to hire more people, but they see the potential in the economy right now, and it's just not looking good, guys. It's not looking great at all because of just so many different factors, macroeconomic factors. There's inflation, there's war. It's just not looking good as a whole. And so you're going to see a lot of companies, even companies like Facebook, down to all the companies that are not nearly as cash rich, they're going to see a lot of slowdown in growth. And that's just the reality that Charlie Munger has pointed out, and I tend to agree. I totally see that as well all across the board in the current economic status. The other thing that Charlie Munger pointed out is volatility will likely be elevated for the foreseeable future. And if you think about it, guys, right, like just based off of what I said, with inflation, with war, guys, I heard that even Russia has been just wasting natural gas. Millions of gallons of natural gas is being wasted every day, and natural gas is expensive right now. And people are going to really need it, especially in the winter, right? So all these factors with waste, with war, with inflation, guys, it's not going to be looking good. And if you take a look at the VIX score, which measures volatility in the market, it is elevated, right? It's been elevated in the last couple of months. It has not really gone down that much. There's so much uncertainty with everything that's going on, with oil prices, with housing. Housing is going through this really, really tough time. With cars, right? A lot of used cars is getting more and more expensive. And, just with so much uncertainty in the market, there is definitely going to be uncertainty all across the board in the stock market. Okay, so number three, the third thing that Charlie Munger pointed out is a market crash is very possible. Now, this is one of the things that a lot of people have been speculating and just talking about if there's going to be an actual market crash, right? We know that in the last couple of months, the stock market as a whole has gone down 20-something%, right? And there was a short rise in June. But as many people pointed out correctly, in the dot-com crash and the 2008 financial crisis, there was always this short rally that came before the big drop, right? So, it's just one of the things that history has shown is that in every crash, there's been rallies in between. And we see a lot of that happening right now, right? We see short rallies, but we haven't really crashed to an all-time low yet, right? Like, yes, the market has suffered a lot. Yes, the market is brutal this year. It hasn't crashed as much as it did in previous market crashes. Do I personally think there's going to be another market crash? In all honesty, I really don't know. And that's one of the realities that most people have to face, is that no one really knows where the market is going to go. In the last quarter, we've seen inflation start to go down, but really the federal government has to see that inflation go down month after month after month, right? There has to be 3, 4, 5 months of inflation really going down before the federal government can be like, okay, we are done raising interest rates. We can either stay the same or we can start to lower it, right? So those are some of the implications of what's going on. And so what's the takeaway, right? The takeaway, guys, is number one, because no one can predict the market, I personally would stay invested. But number two is you can consider different investments right now that could potentially hedge against inflation. And that's what I want to talk about in this video. Okay, so I wrote an article recently about The Big Short, Michael Burry. is getting rich off of farmland. And not only is Michael Burry invested in farmland, Bill Gates, Microsoft's owner and founder, is also invested heavily into farmland. Okay, they made a lot of money. And I talked about in one of my previous articles and videos that in the last quarter, Michael Burry sold out of a lot of his positions in his hedge fund, right? So he basically sold out everything except this one REIT called Geo Group, which basically invests in prisons, right? A lot of people were speculating, why is Michael Burry selling out of his positions, right? Does he know something? Does he think something's going to happen? Michael Burry can't predict the future either, right? He's made a couple good bets on speculating where the market direction is going to head next, but no one can really predict the market. And so there's two really important things that I think is really important to note about any hedge fund investor. And that is, number one, you never really know what an investor is doing personally in his portfolio, right? Investors have a lot of cash, a lot of money in their hedge fund, right? But personally, they also have massive amounts of wealth. And that's something that we can't really know for sure what Michael Burry is personally invested in. Number two is that a lot of times, even though we can see what the last quarter's portfolio moves have been, we can't really know what Michael Burry has done just days after he revealed his last quarter's portfolio, right? In just the previous portfolio, Michael Burry had bought, Booking.com, Google, Warner Brothers Discovery, all these different stocks, and he shorted massively on Apple, right? But we found out in quarter two that he has sold out of all of his positions. Now, when exactly did he sold out? We don't really know. It's very likely that Michael Burry actually lost quite a bit of money in his portfolio because of his shorts against Apple and his positions in Google, Warner Brothers, and other positions. So why is Michael Burry invested in farmland? One of the things that we know is that Michael Burry has been invested in farmland for several years, so for over 12 years, right? There was an interview by Bloomberg 12 years ago where Michael Burry basically said, I believe that agricultural land with water on site will be very valuable in the future, and I've put a good amount of money into that, so I am investing into alternative investments. And the interviewee basically was surprised, and he even asked him, so what percentage of your portfolio personally have you invested in farmland? Burry answered, I don't want to disclose that, but it is a significant amount. So what's so appealing about farmland that attracts investors like Bill Gates and Michael Burry? Okay, the first thing to know is that farmland has actually outperformed all other asset classes. And that includes REITs, the S&P 500, gold, and treasuries, right? If you take a look at this chart below, you'll see that farmland has outperformed all these assets that tend to usually do pretty well in times of growth. Okay, so on top of that, if you take a look at the analysis of returns from 1972 to 2016, you would also see that US farmland has outperformed all these different classes, the S&P 500, the New York Stock Exchange, the TCM 10-year, AAA, gold, REITs, everything, right? The annual average return of farmland has been about 10.23%. So farmland actually has above average returns with below average risk. Number two is farmland hedges against inflation. And as we know, inflation is going out the wazoo. Okay, so the reality is we can't produce more land, but we will always need food, right? Food is vital to our society. And not only that, guys, the population has been growing significantly. The United Nations said that by 2050, the population is going to grow to about 10 billion people. Farmland Partners, one of the largest REITs in farmland, said this on a recent conference call. I think year over year, we're going to see another gain in the 10% or more asset appreciation. That's after the 2021 year may have been as high as 15 or 20% improvement in asset values. Our revenues are up strongly. The rent releasing process that we are in now, we have released approximately 1/3 of the farms, and that are up for renewal. And we are getting in excess of 15% rents bumping in that releasing effort. So basically they're collecting more rent, they're still profitable, they're doing very, very well. So if you fear inflation and you want to invest in an asset that outperforms, stocks, gold, everything, farmland is a really, really good choice. Number three is farmland preserves wealth in uncertainty. And as you know, there is so much uncertainty going on right now with the Ukraine war, with inflation, with all the things that are happening right now in the economy, right? But the thing about farmland is it is something that we will always need, right? We will always need food. We will always need land. Land will not grow, but we as a population will continue to grow. And not only have we seen that in recent years, we've seen that in the great financial crisis in 2008 and 2000, where farmland always outperformed other classes in those crises. Every time there was a crash, farmland continued to do pretty well. Number 4 is farmland is predictably necessary. And that's something I already mentioned, is that we will always need farmland, food, and water, despite what's going on in the world. Okay, so I think that's all I'm going to cover in this video. If you want to take a look at my article, make sure you go on Medium and search for my name. You can read the article, you can look at the stats yourself, and make your own decision on what to invest as well. Make sure you subscribe to my channel or my Medium. I would really, really appreciate it. Okay, so how can you invest in farmland? So if you have the kind of wealth that Burry has or other accredited investors have, you can potentially invest in farmland privately. Okay, so that means you can go out and actually buy a piece of farmland. But for most people, this is not something I would recommend at all. And number 1 is because there's not any kind of liquidity if you buy land. You can't sell your land at any given time. So one of the easiest ways to invest in farmland is simply through real estate investment trusts. Okay, so REITs. And that's because real estate investment trusts doesn't require the very specific skill and diversification that you would need to actually buy farmland. The 2 biggest REITs for farmland are Farmland Partners, stock ticker FPI, or Gladstone Land, stock ticker LAND. Okay, so here's a pro tip that I want to mention also in this video, is that I think what would make investing into farmland really interesting is if you use leverage. Okay, so leverage is not something I usually recommend because it's so risky. But because farmland has relatively low risk, but with a pretty decent return prospect, I think it's totally fine if you want to use leverage on farmland. And the way you can use leverage is you can either borrow off of your securities or you can borrow off of your home. Now, I would usually recommend borrowing off of your securities before you get a HELOC. Okay, so, and the reason being is because borrowing off of your securities is much easier. You don't have to go through a process of trying to get the loan off of your home. If you open up an Interactive Brokers account, which is the brokerage that I highly recommend, you can actually borrow off of your equities and only pay less than 2% of interest on any money that you loan from your securities. So what that basically means is if you buy, for example, a basket of stocks, right? The value of the stocks that you bought, you'll have buying power based off of that because you can actually borrow off of the amount of securities that you bought. So let's just say you buy $100,000 worth of stocks. If Interactive Brokers allows you to borrow 50% of your value, you have 50% more money that you can potentially borrow and pay 2% interest on that. And basically, if your return over time is greater than 2%, then you're gonna make money. And that's how you use leverage. Okay, I hope you'll enjoy this video. If you like this content, if you find anything helpful in this video, I would really appreciate a like and comment below. Let me know what you think about farmland. Let me know what you think about my idea of leveraging farmland. Until next time, guys, thank you so much for watching. We'll see you around in the next video.